when you look at a concentration, the first thing, and this is the most important, is what's your downside? If you're looking at a situation where there's almost no downside, I mean, like everything has downside, stuff happens, exogenous events happen you can't predict. But when you don't think there's a lot of downside, you think there's a lot of upside, well, then you put it on, and you size it up. There's a lot of situations where you can look at them and you can say, look, I think it might be 30% downside, but maybe it's 1,000% upside. And you can't size that at 20% of your portfolio because you don't want to lose 600 bips. And, you just start like going through what the math on it is. I'd much rather have a position that I think is only 3x upside, but it has no downside. It's trading for less than cash, let's say, and it's profitable. Like it has no, mark to market, can do whatever it wants, but it has no downside. So maybe it doesn't hit even our 5x threshold, but you can't lose money, then play it big.
Welcome to the Investors Podcast. I'm your host, Kyle Grieve, and today we welcome Harris Kupperman onto the show. Harris, welcome to the podcast.
Hey, thanks for having me on.
So one thing that I found super fascinating about your investing story is just your overarching strategy, which is a lot different than a lot of the people that we talk to on the podcast here. So a big part of that strategy is making, concentrated bets specifically on macro inflections. And what really interested me here is that there's so many investors that clearly are trying to profit from macro events, but they usually end up getting either the event itself incorrect or the market's reaction to it wrong. So I would just love to dig in here. How have you been able to do this so successfully? And, given how low the average investor's success rate is and with this kind of approach?
I don't know if my success rate has been very good either. I'm probably batting about 50-50. I think the difference is that when I get it right, I get it really, really right because I let these things run. And when I get it wrong, I don't lose too much. I try to set up every trade with a risk reward where I'm buying a bunch of equities that are beaten down, that are unloved, that have super low expectations, low valuations. And look, when I get it wrong, and I really get a lot of these wrong, I usually get my money back plus or minus 10, 15%. And when I get it right, I'm not putting anything on the books that isn't at least a 5x in the next 3 years. But I'm really looking for, more than that. And so when I get it right, I get it really right. And when I get, like I said, when I a lot of times it's not so much that you lose money when you get it wrong, it's that it ties up capital for a year, 18 months. And the theme is sort of working. It just doesn't have the strength to, push the equity multiple because, it's not just earnings growth. It's really equity multiple that you're looking at. You're trying to find things where other guys are going to get excited about it too. And so sometimes, the earnings are growing, but, you thought earnings were going to grow 30% and they're growing like 12, and so you make a little bit of money. And I think that's the key to this, make sure that when you set up your trade, you can't lose money. That's always the number one rule of investing.
Yeah, exactly. And I think that speaks to, the frequency and magnitude effect, right? If you can be wrong, but as long as, like George Soros says, it doesn't matter as much as just when I'm right, I need to make a lot of money. And when I'm wrong, I need to hopefully minimize my losses.
Right. I mean, if you look at kind of, the history and, I've had a fund now, this is year 7 for our fund, but, I've been doing this a long time before. It's either a lot of things work, a lot of my ideas are just working in unison and, we're going to be up huge that year, or nothing really happens. We're up or down smallish, usually leads to the upside, just because of event driven. I think we'll talk about that in a little bit, but, that's just usually the return profile. It's odd for us to ever have like an up 40 year, we're either going to be up triple digits or hope, we're going to be kind of, bunch, or 10-15 on either side of bunch, hopefully we don't have any big down years, right? That's the real goal. If you avoid your mistakes and you get out of your mistakes fast, the winners solve most of the problems for you, right?
Right. So something else that really stood out to me was how you kind of balance both these event-driven trades to kind of self-fund some of your longer core positions or longer-term inflection bets. So, you use this specifically so that you can fund these long-term bets when there's market drawdown. So I'd love to dig into this a little bit. Are you usually staying completely fully invested? So, and is this the strategy that helps you free up capital when those big opportunities do end up coming around?
I mean, we're usually pretty well invested. I mean, look, there's more to do than I have capital. That's always been the case. Sometimes, we'll get a little skittish and pull back, but there's always a lot to do. On the event-driven side, when the markets are volatile, we tend to make money. Event driven means a lot of things to me. We're tracking about 25 event driven, sort of corporate events. These are like spin-offs, privatizations, demutualizations, restructurings, and CEO change. We're tracking about 25 of these things. I actually have a publication called KEDM, KEDM, if you want to take a look at these strategies they're tracking. But they tend to give you really interesting setups where something's going to happen, roughly the timeline of the thing happening. And there's usually a probabilistic sort of trading opportunity around those sort of events. And we're active in a lot of these. Obviously, there's going to be hundreds of them a month, and we're going to choose 5. But we're active in these. We're also really active just in what's in the news. I'm a reasonably good just discretionary trader, and when stuff's in the news, when markets are volatile and moving around, I'm just going to be taking trades, and it's additive. The whole point of event driven is you never want to lose more than 100 bips in a mistake. So you size it appropriately, based on risk reward, and you try to do this over dozens of situations during the quarter. You're trying to grind your way forward, and occasionally you get escape velocity on something and it really hits it out of the park. You're just really trying to set up situations where you can't really lose much and you make some, and it produces a really consistent cash flow. In my experience, event driven will have a couple months each year where it's very profitable, a bunch of months each year where it sort of makes small, and then 1, maybe 2 where you lose a little. But it's pretty rare that we lose more than 50 or 100 bips in a month on event driven, and it's quite likely that we'll be up a couple hundred bips in a month. And so you have this additive sort of cash flow in a way. And I hate to use Berkshire analogies because they're overused, but Buffett has an insurance business which produces cash for him in most years. And I have my event driven, and it produces cash for me. And when the markets are volatile, which for instance right now they are volatile because you never know what Trump's going to tweet yet next, and I don't even know if Trump knows. There's going to be a lot of pin action. There's going to be a lot to do. Implied volatility is, structurally like 5 to 7 points higher now because of Trump, which means that, every time something happens, you can sell puts and calls and earn your yield that way. There's just a lot to do right now. And, the core book is not doing so great. The markets are kind of trending lower this year. And, the event driven has really offset a lot of that drawdown in my book and given me cash that I can just keep averaging down my favorite ideas. And, it's doing exactly what it's meant to be doing. And, I'm super happy with the way it's been going this year. And that's how it goes most years. It's rare that we ever have a losing year in event driven. It's rare we even have a losing quarter, but we tend to make good money.
And so, are you tracking specifically which side of the book, whether that's event driven versus core, has been driving the most returns? It sounds like you definitely do.
We definitely track it.
Yeah. And so is there kind of, would there be kind of a time in the market where you'd go maybe all in or focus more on one side depending on the opportunity set that you have?
Yeah. Look, event driven goes in cycles. You'll have a couple good months, then it kind of trails off. You'll have a couple good months. And when things are good, you want to put a little more capital into event driven. The way event driven works though, is it's often self-liquidating. If you write a put on something that's oversold and you say, look, the stock's gone from 60 to 40 and I don't mind owning it at 35. Well, I'm going to write the 35 put. I'm going to get paid my $2. And 45 to 60 days later, either I've gotten, my stock and, I got it below the price I was going to, where the put was, or I've earned my yield. And these things tend to be very self-liquidating. And it tends to be that by the time that put expires, the stock's either moved up or it's moved down and I've been assigned. So I can kind of overdraft in a way off the core portfolio. And we could, like say we're running a 110 exposure in the core book. I can always overdraft another 1,000 bips, which lets me, write puts or, do a couple of these strategies. It gets me to 120, we kind of target this 115, 125 range. So it gets me right into like the middle of my target exposure. We could take exposure up if something's really good in event driven, or we can, sell a position if we need something in event driven. If there's a really good privatization or a really good spin or a really good bankruptcy emergence, and we say, look, we're going to size this, a lot of the event driven stuff's like 50 to 100 bips exposure. We're going to size this 500 bips. We really like this. Well, then I got to go find 500 bips somewhere. I can't just, go from 120 to 125. You start pushing your exposure too much and you never want to get too overexposed. There's a couple times a year where maybe it makes sense, and about once every 10 years where it really, really makes sense. But, on that 125, 30. That's really a ceiling. You don't want to go above that, especially because we don't short, we don't really hedge.
So another thing that I think really resonated with me was your focus very specifically on absolute returns. So, you've had some just incredible years. Like, I mean, you already mentioned here that you had a couple of years here where you've had triple digits, and that was in 2020 and 2021. And then, even in 2022, when the market was, kind of getting slaughtered, you ended up with a positive return, which was very interesting. So let's dive in more into how you develop this mindset kind of to focus more on absolute performance when, it seems like 99.9% of other funds are very locked into specifically relative returns compared to an index.
Right. Well, I mean, I think most hedge funds start with the initial principle of I want to build a return stream that lets me go market. The big money comes from institutional investors, pensions, endowments. So I'm going to build a return stream that, the teachers' pension of Cleveland and the firefighters in Mississippi, like these guys want this return stream where we don't have, any down quarters, hardly any down months, and we make 1 to 2% a month positive on average. And we end the year up 13. And that's a really good return stream. That lets you manage tens of billions of dollars and become a very, very wealthy man. The problem is most people can't achieve it. But if you can, you will make a ton of money, right? I approach this with a very different approach. I say, look, this is my PA, private account, sorry, PA. I'm going to run it like my PA. And if anyone wants to come along, they can pay me a fee and they get exposure like it is my PA. We've been very lucky that we've been able to get quite a few investors. We have about 190 investors right now. We've grown the fund quite nicely. But I really treat this just as my PA, and it's a very different approach. And it means we're going to have a different return stream. But the approach is, would I do this with my own money? What do I want to do with my own money? Look, I want to make the most money possible in my PA, right? And I don't care if it's volatile. I don't care, how we get there. I don't care if it's lumpy. I just want the best rolling 3-year returns I can achieve. And there's always in the markets these weird opportunities that are created by this institutional incentive structure of trying to get to 10 billion of asset. And when you want a really smooth return profile, it means you can't do a lot of the things that we do. I think one of the most obvious ones is that most investors right now can't own a stock if they think Q1 earnings will be bad, right? So if you know that Q1 is going to have a bad print, but you think Q2 and Q3 will be great, and then Q4 outstanding, well, you can't buy it until after the Q1 print. And if you think Q2 will be sort of mediocre and maybe Q3 is the inflection, then you can't buy it until the Q2 print. Well, I take a very different view and say stock prices are sort of random. We've become not super large. We've gotten larger, so we're going to impact price sometimes. Well, I'm just going to average in. If Q1's terrible, I'm going to buy some more. If Q2 means the stock goes down another 10%, I'll just buy more. Eventually, I'm going to have a really good cost basis. And, I feel like a lot of funds also are very IRR focused, which means they have to catch it when it's going up. So if a stock is at 12 and you say, well, the chart, is doing the squiggly thing. And every time it goes to 13, it stops. And every time it goes to 11, it stops. I'm going to buy it at 12. And no, sorry, I'm not going to buy it at 12. I'm not going to buy it at 13. I'm going to buy a breakout at 14. Okay, great. You just paid up 15 or 20%. Like I'm saying, look, I'm going to buy it at 11. I'm going to sit there at 11. And if it goes to 9.5, I'm going to buy more. Because if you're going to buy it at 14, what does that do? It means you're going to sell it when it drops to 13 or 12. You're going to stop out and you're going to buy it again next week at 14. Like it makes no sense. Like I just want to buy it as cheap as possible. And this is because, most of my net worth invested in this fund. And my focus isn't IRR. My focus is not losing money. My focus is buy it as cheap as possible, so there's as little downside as possible. And then when it turns, and no one knows when it's going to turn, I'm going to catch that turn. And then the guy who's buying it at 14, I'm going to look at him and say, I bought it at 11. I mean, that you missed out on a 25, 30% move. I mean, in our industry, that's called a good year. And, so I don't understand that logic. But like I said, a lot of things don't make sense to me in finance, and a lot of people from the institutional world tell me stuff, and I go, okay, that's nice. I don't know why you people do it this way. I do it my way. My way seems to work for me. It doesn't work for other people, and I've sort of accepted that. And that's just me running my own PA with 190 people, coming along for the ride.
Love it. So I'd love to dig in a little deeper. I mean, we've talked a lot about the core book and your event-driven book. And, I know you don't like using these Warren Buffettisms, but I can't help but mention him here one more time. So, he kind of somewhat similar to you, not exactly, but he had multiple buckets when he was running his partnerships, where he had his generals, which were kind of similar to what your core book would kind of be. And then he had, his turnarounds and workouts that I guess would end up offsetting sometimes when the generals would, not be performing so well.
Right.
So, I'd love to know, how are you thinking about balancing, these two parts of your portfolio in terms of concentration? How does concentration maybe shift where the best opportunities lie, especially in relation to the core book?
Well, I think it's just exactly what you said. Where the best opportunities lie. If event-driven has a bunch of stuff coming, and the thing with event-driven is that we're tracking these things. So, like, sometimes stuff comes out of nowhere, like a CEO change, and they just press release it. But a lot of times, there's going to be a demutualization, and it's coming for the next 6 months. So there's a pretty good chance we're going to commit capital in this situation. So we need to free up capital. So there's a lot of that. I mean, sometimes something happens in the news, and with Trump, this news every 3 hours, and so sometimes it's very reactionary. But a lot of it is just. We never run fully invested. We have a self-imposed cap at 150 exposure. You never want to get there though. Like if you got to 150, it's danger zone. But we're usually running this at like 115 to 125, like I said, which gives us at the midpoint at 120, gives us 1,000 bips of room to flex up our exposure at any moment. And then when you flex up the exposure, you don't want to immediately have to sell something because you don't want to impact price, but you kind of look at the book and you say, well, where do we go find ourselves, 500 bips to, take the exposure down. And then over the next couple of weeks, you better take your exposure down somewhere. And so it's really just where the best opportunities are. We have some names in the book that we've owned for a few years. We're probably going to own them in a few years. So that's not where we flex. But one day those stocks will get valued fairly, and we'll get that capital back. It's more that we have a bunch of names that kind of cycle through the book. They tend to be, a couple of weeks on the event-driven side, maybe a month or two. And we have a bunch of other things that are more like inflection-y oriented, where it's a clear catalyst. It's coming in the next 6 to 12 months. We're positioned ahead of the catalyst, and we're probably going to sell 3 months after the catalyst. And there's a bunch of that sort of stuff, and it's got a 6 to 24 month duration on it. And so that recycles pretty fast.
And do you have any constraints specifically with each side of the book? Like, do you prefer to keep your core book, at a specific concentration level, or does it need to stay above a specific level?
No, I mean, when there's nothing to do, you take it down. I started getting bearish in the U.S. economy last spring, and we kind of have a culling, we called it, or I guess a purge is kind of what we called it internally. And we're a bunch of names that, if the U.S. economy is going to soften, and it has softened, I think, it might not show up in the official data yet. I mean, the official data says the economy is still growing, but, everything in finance is done on rate of change. And so the rate of growth is slowing, your second derivative, which means that equity prices are going to decline. You want to get out before that. And we made a lot of sales. I wish we'd sold more, quite honestly. But anything that had GDP exposure, we sold. And having done this for a long time, I know that there's always some illiquid things. Well, not totally illiquid, but when you own a couple percent of a company, it's going to take you maybe a couple weeks, couple months to get out, especially if you don't want to impact price. And so you just kind of know, like, it's going to take me 60 days to get out of this. You better get going, And so we kind of cleaned up the book that way. And we do that from time to time. We just clean up the book. But no, I mean, there's no target. We just kind of go where the opportunities are.
So let's talk a little bit more here about culling your portfolio, because I really enjoyed reading about that. You had an article, and you also mentioned it in your shareholder letters. So, basically what it was that you felt like there were specific positions maybe that were lower conviction bets or just smaller positions in your portfolio. And, why keep those when you have higher conviction ideas that you can put some more money behind? So, but the question here is, with someone with maybe more of a value investor mindset, how are you building the discipline to really sell off some of these smaller positions, even if, like right now, I'm sure a lot of these smaller positions are probably looking really cheap and attractive?
Hey everybody, it's Clay Fink here, host of We Study Billionaires. About 2 years ago, we launched our TIP Mastermind community to create a place for value investors to talk stocks and connect with other like-minded people. And since then, I've had the pleasure of connecting with a wide range of really interesting members of the community, many of which are entrepreneurs, private investors, or portfolio managers. We host weekly live Zoom discussions that feature Q&As with podcast guests, social hours with TIP hosts, stock presentations, and member spotlights. And coming up in May, we'll be hosting a few in-person events for the community in Omaha during the weekend of the Berkshire Hathaway annual meeting. Our in-person events especially serve as a great opportunity to have authentic and real connections with successful people who come from all walks of life. Whether you're wanting to talk stocks or simply want to network with like-minded people, I would encourage you to apply to join our TIP Mastermind community today, as we're temporarily closing the group to new members at the end of March 2025. Simply go to theinvestorspodcast.com/mastermind to join the waitlist to apply. That's theinvestorspodcast.com/mastermind. For decades, real estate has been a cornerstone of the world's largest portfolios, but it's also historically been complex, time-consuming, and expensive. But imagine if real estate investing was suddenly easy. All the benefits of owning real, tangible assets without all the complexity and expenses. That's the power of the Fundrise flagship real estate fund. Now you can invest in a $1.1 billion portfolio of real estate starting with as little as $10. 4,700 single-family rental homes spread across the booming Sunbelt, 3.3 million square feet of highly sought-after industrial facilities thanks to the e-commerce wave. The flagship fund is one of the largest of its kind, well-diversified, and managed by a team of professionals. And now it's available to you. Visit fundrise.com/WSB to explore the fund's full portfolio, check out historical returns, and start investing in just minutes. That's fundrise.com/WSB. Carefully consider the investment objectives, risks, charges, and expenses of the Fundrise flagship fund before investing. This and other information can be found in the fund's prospectus at fundrise.com/flagship. This is a paid advertisement. Are you struggling to stay focused? If you're looking for something that can help you really hone in your work without all the distractions, Remarkable, the paper tablet might be just what you're looking for. So what exactly is a paper tablet? In short, it's everything you love about paper, but with the power of modern technology. Remarkable just released their 3rd generation paper tablet, Remarkable Paper Pro. It's thin, minimalist, and feels just like writing on paper, but comes with powerful digital features such as handwriting conversion, built-in reading light, productivity templates, and more. That means no apps, no social media, and no distractions, just pure focus. Whether you're in a meeting or deep in a creative session, this device is built to keep you in the zone. You can even try Remarkable Paper Pro for up to 100 days with a satisfaction guarantee, or you get your money back. Head over to remarkable.com to learn more and grab your Paper Pro today. That's remarkable.com.
So we have some of these names that we've had for a while. I'm just pulling up the ticker right now. I'm sorry. One of them, look, we owned an Italian newspaper company, media company, RCS. We owned quite a lot of it, and it had been a large position for us. And as we had inflows and as we had performance, the position just got diluted down to the point where, it was 1%, a little less than 1% of our capital. And we kind of said, so I have this very strong view that I don't want to have anything that's less than 500 bips. Either we have tons of confidence that we're going to make it bigger, or if we don't have the confidence to make it 500 bips, then we should own it, right? It forces you to concentrate on your best ideas, and it forces you to really know your names. I have a team that supports me here, and so it's super helpful to have them. But we go out to dinner once a week and go through all our book, and it's never the little names that you focus on. It's always the big ones. And so I feel like, we avoid landmines that way. And you kind of want to jettison the things that you're not really focused on in the same way. So we had this stock and we knew it was cheap. We loved it. We loved management. And we just said, it went down from a couple hundred bips to less than 100 bips. And you can't size it up just because, it's not that liquid. Let's just exit it. And, I'm looking at the chart now. It's up it's up a lot since we exited. It's up like almost 50%. We sold it last summer, and it doesn't hurt me. It doesn't bother me. We took a bunch of dividends out of it over time, and it was actually an okay IRR, not great. But I don't let these things bother me. I'm not really very backwards looking. It's more of it wasn't like there was anything wrong with the names either. It was just that we kind of said either we take this to 500 bips, which would be probably difficult, or we shouldn't have it. And I don't mind having a large position in a cheap Italian newspaper company, but it's just not what I thought there'd be better opportunities. And I just have no regrets. And there were a lot of things like this that we just kind of sold. A lot of things that started off as 500 bips or 300 bips, or it was a basket of 2-3 names, and the basket diluted. There were also a lot of things, like I said, that had just economic sensitivity, especially the US ones. And we looked at these and we just said, we think we're going to have a slowdown. I don't want anything with economic sensitivity. Let's get rid of them. And a lot of those sort of things are now 30 to 50% from when we sold them. So I'm glad we had to cull them, because especially when it's going to take you 60 or 90 days to get out. Like, I'm glad we got out before, because now it's dawning on people there's going to be a recession and there's no bids left.
So you mentioned there that you prefer to have a position that you can take to 5% of your portfolio or even more. So let's dig into a little bit more about concentrating bets here. So I know you've mentioned that you've had just 3 bets making up over 50% of your portfolio at any one time. So clearly you're willing to go very heavily concentration in something that you believe in. But given that you also have these short-term trades in the mix, how do you kind of decide how concentration goes across the whole portfolio, and what makes an idea strong enough to warrant one of these very large allocations?
So when you look at a concentration, the first thing, and this is the most important, is what's your downside? If you're looking at a situation where there's almost no downside, I mean, like, everything has downside, stuff happens, exogenous events happen you can't predict. But when you don't think there's a lot of downside, you think there's a lot of upside, well, then you put it on, and you size it up. There's a lot of situations where you can look at them and you can say, look, I think it might be 30% downside, but maybe it's 1,000% upside. Well, you can't size that at 20% of your portfolio, because you don't want to lose 600 bips. And you just start like going through what the math on it is. I'd much rather have a position that I think is only 3x upside, but it has no downside. It's trading for less than cash, let's say, and it's profitable. Like, it has no, mark to market can do whatever it wants, but it has no downside. So maybe it doesn't hit even our 5x threshold, but you can't lose money. Then play it big. I think that's a lot of what goes into it. It's also just what you think the best things are, what have the strongest tailwinds, what's really working. And yeah, I like to play it big. There's not a lot of opportunities in the market. I mean, you have this sport called investing that attracts the smartest people in the world. Every day is like an MVP, all-star game. And you're going up against the smartest people and the smartest computers, and there's just not a lot of really interesting stuff to do. Most things are fairly priced. And so when you find something that's really quirky and interesting, well, you got to play it big. And the whole point of a hedge fund is we're supposed to dramatically outperform over, in my world, a rolling 3-year period. I mean, you can't just have 20 ideas, because you're going to sort of look like the benchmark. And, no one wants to pay you for that. Like, you'd better be able to outperform, and outperform by a lot.
So you've mentioned here in that example that you gave earlier, where you have no problem with averaging, down onto a position if the price goes down, depending, like you said, if 1 or 2 quarters is going to be soft. So I'd love to know more about just generally how you get into a position. There's kind of these 2 schools of thought that I've generally seen, where certain people are like, you should know everything you know about a business, then you just go all in on one position, or not all in, but just like, take it to whatever concentration levels you want at a reasonably fast pace. And then there's another field of view where people are like, okay, well, maybe I'm going to get to understanding this business at a reasonably high level. Let's call it 60, 70%. And then over time, as I start understanding the business more and more, seeing how it plays out over a few quarters, I'm going to add more and more over a few quarters. So, which line of thought are you on that spectrum?
Well, we're usually looking at something that's inflecting. We're usually looking at something where we think it's going to be dramatically higher and the results can be much better. And something's, at play. And as a result, we like to think we're intelligent, but there's a lot of smart people that might just be a couple days behind us in figuring something out. And so we like to buy when we've done 1/3, 1/2 of the work, start buying. And as we do the work, we'll maybe buy some more. But we kind of have this knowledge that if we figured something out, or we thought we figured something out, someone else will come up behind us. And so we'll have exit liquidity if we decide we don't want to be in. But it's usually something really in motion. I gave you the example before of something where we think Q1's a bloodbath, but we think Q2 is kind of, the turn, and then Q3 is going to start looking good. Well, then we'll buy a bunch now, because by the time they announce the bloodbath quarter, they're going to be guiding higher already. And then everyone's going to forget that last quarter, that's rear view. Everyone's going to be looking forward. And so maybe it drops 10% on the earnings print, but it plays, it's going to end the week higher. And so, we're usually buying at the moment that it's turning. My biggest mistakes are the ones where I'm buying and then averaging down and buying. If I'm averaging down, I made a mistake. I saw like a market crash or something. Like if I'm averaging down, I made a mistake. I mean, I'm not saying I'm always averaging up, but I'm usually out there fighting for shares against a couple other guys that figured out the same thing I figured out. I'd say the other time we're buying is if you look at one of these trends, okay, we do a lot of cyclical industries. Let's say the cycle's going to last 10 years, okay? Just made up number. And usually at the bottom of the cycle, when we're buying, the company's losing money, but we have line of sight that it's going to get a lot better. We're buying a lot, right? Then it starts making money. Things are good. The stock goes up 2, 3, 4 times. And then eventually there's going to be a bad quarter or two, because the way these industries work, people overstock the product, and there's like a destocking phase, and it goes like, it's like a sine curve, but it's upward sloping. And so because it's such a cyclical industry, everyone goes, oh, the cycle's over. It's only, 18 months in, the cycle's over. Let's take my ball and go home. And the problem is that the cycle's not over. It's just a destocking, the price of the gizmo, it went from $100 each to $200 each, and it costs $150 to produce it. And now it's pulled back to $160. So it's like sort of making money, and everyone's like, okay, and the stock will be down like 60%, right? So you buy the stock at 10, it goes to 50, and then it drops to like 25 or something, and everyone panics. And that's usually when we've now had 2 years to learn this industry. We've usually figured out what's happening. We have a much better understanding of what's happening. We have good relationship with management. That's usually when we double and triple dip on it, because before we were buying something that was sort of clunky, that we were really hoping and praying would fix itself. And here we are. They've had a year or two of retained earnings. They've delevered. They've maybe bought some competitors. Consolidation is always great for whatever cyclical industry it is. And it's now cash flow positive, and they're using that cash flow for buybacks, which means you're going to, have a, bigger ownership of it. And everyone's freaked out. They think the cycle's over. We're like, no, guys, because we do so much of the cyclical stuff too. We're just like, no, guys, the cycle's not over. Like everyone who is going to do a capacity expansion, they just put it on hold. The bank said, whoa, we're not lending to this. The boards of directors are like, no, guys, because you lever. Like it puts the whole process on hold. That's why these cycles last, 10 years, let's say, instead of 4 years. And so that's usually when we're adding on the way down. And for some reason, I always buy too soon. I always, it goes from 50 to 30. I'm like, guys, it's so cheap. And then it goes to 25, and I'm like, oh, I'm buying it. It bottoms at like 19. There's that crazy day where it drops to 17. And, like some guy gets a margin call, and it's funny. All the brokers that are like, I have a $100 price target. 6 months later, they're like, yeah, we have like a $12 price target, and we're a strong sell. And like 6 months later, they're back to $100 price target. It's like, you guys have never seen a commodity cycle. Like, come on. And so that's the only time we're buying on the pullback. And as I get older, and I'm already kind of an old man, as I get older, I want to make sure that I'm a little more patient on those pullbacks. I think that's where I've probably been a little sloppy. I just get so optimistic about these things, and I feel like other people have actually done homework, but in reality, no one's done homework, and they just get spooked out. I mean, we're in one of these right now, and I get like 10 emails a day from people asking what's happening, and I'm saying, nothing's happening. Like, go buy some.
So back in January of 2024, you pointed out that the Mag 7 were driving much of the index's gains. And, we fast forward to now and they're up another 44%. So with that in mind, I'd love to get your latest thoughts on market blowoffs, which you've discussed in some of your articles. So you mentioned that there's certain moments in time where, the markets end up blowing off. And, an example that you gave was the tech bubble, where capital would rotate out of these expensive names and then go into cheaper names. So, are you thinking that you're seeing this play out, right now? And is that a kind of a catalyst that you're looking for to drive returns in certain businesses you own, like things like St. Joe or some of the offshore services plays that you own?
So I think we have had a bubble in, call it Mag 20. Everyone knows the Mag 7, but I'd add in, a bunch of other things like Walmart and Costco and Starbucks and these like mega cap stocks. I mean, a lot of them, say what you want, at least most of the Mag 7 stocks, are reasonably good businesses that have a lot of cash flow. And outside of Tesla and Nvidia, they're not particularly expensive. You look at like Walmart, it's 40 times earnings and it doesn't really grow. I mean, it grows a little. Like, Starbucks is a shrinking business. Like, you look at some of these things and you just kind of wonder why they traded the valuations they do. And I mean, it's been just nonstop passive inflows into the United States. It's created a bubble because the capital goes to the largest stocks. And I think that bubble, think of it like a capacitor, right? And then, like it takes in all this energy, and then finally it just like releases, boom. And so it's taking in all the world's liquidity, right? I have a lot of friends who live overseas, and I'm asking them about their markets. We're long Brazil, we're long Turkey, we're long like all these emerging markets that are doing phenomenally well. And I asked them, like, are you guys investing in your own money markets? And they're like, no, we only own, S&P. I'm like, why don't you own yours? They're like, well, it never goes up. I'm like, have you guys looked at the last little bit? Is it starting to go up? And they're like, oh, really? And it's like the capacitor is just like, boom, and all the capital is going to come out and it's going to go back to these other markets. And, I hope some of my names get a little bit of that, capital release. But I think it just goes everywhere. And it's going to help the valuations of these abandoned equities, I guess, is what I'd call it. There's just a lot of capital locked up in things that, don't really make sense. Like in terms of valuation, it's been like this for so long now that we've all come numb to it in a way. Like there's a lot of these large US tech stocks that don't really make much money. What money they do make mostly goes to offsetting stock dilution. After stock dilution, it actually kind of loses money. You could say SBC is, non-cash, but I don't know, if you didn't pay these people, piles of options and RSUs, could you pay an engineer 200 grand, or would that engineer want $1 million? And if that's the case, well, your business doesn't make any money. I don't know. Like at some point, you kind of have to look at this and say, like, these aren't really very good businesses, right? And they're just not very good. They're cash generative, I guess, but it's kind of like this weird, like cash stock option laundering operation that, like it helps the company raise capital as a deferred capital raise through stock options, and that's how they get their cash flow. Some of these things like Amazon literally have no cash flow. There's some working capital, cash flow, but it's really without an SBC, like that's their cash flow. Like you kind of look at these and it's like, okay, it's a mature business. It makes some money. It's a little hyperbolic to say it doesn't make any, but you kind of look at these, just like, I don't get it. Like, I don't understand who's buying this thing. They have multiple giant businesses at huge scale and they don't really make any money still. Their ROIC is just terrible for a scaled business. But, we don't short much. We're not trying to take sides in these things. We're just kind of looking at this and saying, wow, this is kind of weird, right? And it's gone on for so long, you stop thinking about it. And so we stopped thinking about it. And we're going to focus on a bunch of things that are really growing fast at 3 to 5 times cash flow. Because that's what we've always done, and that's what makes us money.
Yeah, makes sense. So you've highlighted how valuation agnostic traders create opportunities for long-term investors. So there was an example that you gave, let's just say ESG, where there was the opportunities created because people wanted to get, have an ESG fund. And in order to get to that status, they had to sell positions that maybe they had in high quality businesses, and they were just basically essentially becoming forced sellers. So you seem to have played this in kind of a basket bet kind of way. You have investments into companies like Valaris, Tidewater, and Noble. So I'd just love to learn a little bit more about this strategy. How are you trying to, how are you kind of finding these opportunities in battered industries, and maybe not even just industries, but specific companies that nobody seems to want to invest in?
Well, ESG was this weird thing because, for the history of investing, and it goes back, thousands of years, they have, trade receipts on papyrus going back 3,000 years ago. People were, lending money to, guys who owned a ship and they were going to move a cargo from one place to another. Like, this has been going on forever, right? And for the first time ever in the history of society, a bunch of people decided they didn't really want to make money. They were going to try to make the weather better. It's like a weird cult, right? Like, look, I don't want to go into climate, but I don't think, one portfolio manager buying or selling coal stocks is going to make the weather better. I think it's totally irrelevant. I've come to the conclusion that we run a, decently sized hedge fund, but we can't fix the weather. It's just out of my capacity. And a lot of people convinced themselves they could fix the weather. And they all sold stocks. And it was great for us because we bought a bunch of irreplaceable assets at 5 and 10% of replacement cost at a time when they were cash flow positive. And the companies were buying back lots of stock. It was hard not to make a lot of money. And, as is always my curse, I was a bit early because it seemed so obvious to me, but it seemed obvious to no one else. And eventually the selling ended. I think ESG is, we hit the high water mark of ESG, and hopefully it disappears. We never hear about it again. But there was a moment in time where I was a year and a half early, and there was just waves of selling, and there weren't enough guys like me that could buy. And eventually the shares got absorbed, mainly by the companies with their own buyback programs. And then we made a lot of money, like a lot of money. I always ask myself, where are there stupid people that are totally uneconomic? I mean, I think the most obvious one is when someone's getting a margin call. They might love their stock, but if the broker says you have to sell, you have to sell. And oftentimes, really, really rich people got really wealthy because they borrowed a lot of money to get there, and they overextend themselves. Sometimes whole countries do this, and so you have these kind of like idiosyncratic crashes, and it's either one tycoon going bust, or a sector or a country, and I think that's interesting. And I think what's happening with pod shops right now, where they say they can be delta neutral, so every time they buy something, they have to short something. And oftentimes they're totally valuation agnostic. They're much more focused on rate of change. So that they're always showing up in the morning and asking themselves, what industries are getting better? Let's go buy those. What industries are getting worse this month? Let's go sell those. They have credit card data, they have satellite data, they have all this data, right? And so in real time, they're putting positions on what's getting better and what's getting worse. And they don't care about valuation. They don't read a spreadsheet. They're looking at web traffic or something else. And you get these situations where you have companies where 20, 30% of the shares outstanding are shorted and trades at 3 times earnings. And yeah, maybe it's going to get worse. And maybe it's next year 5 times earnings. You kind of look at this and it's like, it's a cyclical industry. Yeah, we know it's getting worse, but it's really cheap. Doesn't mean we have to do something today, but you put it in the back of your brain that once a month I want to check up on this thing, because when it starts turning, all these guys need to cover, and then they're probably going to go long. So, it's just going to be this huge cycle. I think the pod shops have created more opportunity than anything else. I mean, maybe even it's a little bit more dispersed than ESG, but I think there's a huge amount of opportunity. I mean, I'd say a lot of what we do at our fund is we sit around drinking beers and we say, what's happened in the world? Politicians usually have a 2 or 4 year election cycle. And cause and effect isn't really a strong point with politicians. They don't really understand economics. And they often don't really care about the effects, because either they get reelected, they'll figure it out next cycle, or they don't get reelected, it's someone else's problem. And so you have this like weird setup where there's a lot of action, there's a lot of, opportunity created just by having a sort of Austrian libertarian mindset of how economic cycles work and how politicians are mostly crooked, criminals. And if you have a really high dose of cynicism, you're going to make a lot of money as long as you're willing to have a 1 year or 18-month timeline of what's going to happen because some politician just made an unforced error in their domestic economy. But these are the sort of things we look about and think about. There's always something happening in the news. Like every day something happens, and my job is to say, is this just noise, or will this dramatically change something? And oftentimes it changes one little subsector and you kind of miss it. But sometimes even one of those subsectors, someone in my firm is knowledgeable about that. And they say, hey, Kuppy, we think this is about to happen. Okay, let's go buy some. And that's where a lot of our opportunities come from.
Yeah, that makes sense. So you mentioned there a little bit about capital allocation with some of these businesses that, no one liked the stock. And so they were very cheap. And then that was a perfect time to obviously do buybacks below intrinsic value. So I just wanted to ask you a question a little bit here on capital allocation at a business point level. So obviously with these types of businesses, once the buyback strategy is kind of maxed out and there's not enough liquidity to continue going down that road, they kind of have to either pay a dividend or reinvest back into the business. So my question for you is, do you have a preference between the two of them, or are you just purely looking at which offers the highest return?
Well, I mean, there's always capacity to do buybacks. By the time it gets to the point where it destroys capital because it's not accretive, we've already exited, right? So it doesn't bother me that. I don't like dividends. I think they're dumb. No one shows up for 3%. If we made 3% on the year, it's a terrible year for us. So I don't really know who benefits from that. It sort of offsets your funding cost of having a slightly levered portfolio, but that's neither here nor there. I just don't like dividends. I don't feel like anyone buys a 2-3% dividend. No one cares if the dividend gets increased by a nickel. It just doesn't matter, right? Buybacks are what move stocks. That's what I care about. Otherwise, I want to see, consolidation in M&A. I don't want you to go into a new field, but consolidate the sector. We tend to be looking at cyclical businesses. We tend to be looking at things where they probably haven't added capital in a while because the sector is shrink capital. So no one's adding new supply, and the number of players is consolidating through bankruptcy. And so at the top of the cycle, it's 20 guys. At the bottom of the cycle, after all the bankruptcies, it's 7. You get a little bit of pricing power. And let's see if you can buy 2 or 3 more of these and make it an oligopoly with 4 guys, and then push pricing. And in a fixed cost business, pricing is usually very high incremental margin, very high incremental ROIC. I want to see consolidation. That's kind of what I really want to say.
So a recurring theme in some of your 2024 letters was your focus on these kind of hard asset heavy businesses. And that seems to tie directly into kind of your macro view around persistent inflation and high interest rates coming up here into the future. So can you maybe walk us through a couple of scenarios and explain the kind of asymmetry that you're seeing in some of the investments that you've made here in, asset heavy businesses?
So I like asset heavy businesses because obviously everyone looks at earnings, right? Earnings are just something people look at, right? It's weird. A while ago, 20, 30 years ago, maybe when Buffett was first starting out, he looked at asset heavy businesses, and he was very much an asset focused investor. Buy stuff below replacement cost, buy stuff below working capital. The world's really pivoted to cash earnings, I guess. EBITDA, really, not even earnings. Definitely not cash flow. And everything's died on EBITDA these days. But EBITDA is very volatile. And especially in businesses that are cyclical, EBITDA or cash flow, they're dumb metrics, really. Because what you're really trying to figure out is like the mid-cycle earnings. But nothing ever gets valued in the mid-cycle earnings, which is why, guys like me get to make money. When things are kind of bleak and they're losing money, these things are valued at a fraction of replacement cost. And at the peak, they're valued at 3 times replacement cost, which incentivizes them to add capacity. And, even while, the mid-cycle earnings stays pretty flat. So I just look at a lot of these asset-heavy businesses because it is an easy starting point for what you think it can earn. And until it goes, the valuation goes above the replacement cost, they don't add any supply. So you have this kind of break, and the global economy grows a bit each year. And if there's no supply, eventually demand catches up. But what happens in an inflationary environment is that the replacement cost of this piece of equipment, it goes up. And so you're kind of making money. If you have, let's look at like shipping, okay? At the bottom of the cycle in 2017 to 2018, VLCC, which carries 2 million barrels of oil, let's call it an $80 million piece of equipment to buy new. Today, it's about a $130 million piece of equipment to buy new. Part of that's inflation. Part of that is that at the bottom of the cycle, a bunch of Korean shipyards were basically losing money to build these things because they didn't want to lose their workers. And now they have some margin. But I think maybe half and half's inflation. So let's say it costs you $20 million more to build this thing, $30 million more to build this thing. Well, if you have a 5-year-old one of these, it's on your book. Your $80 million cost minus depreciation. But in reality, the replacement cost of this, you can sell it to liquid market. It's not that 80 million starting point, it's 105 million or 110 million starting point, which means if you're going to depreciate it over 20 years for residual value, you move your whole curve up, which means that it's actually appreciated in value. I mean, you can do the math on this and you think you've suffered through depreciation, but in reality, it's probably worth more today than you purchased it for. And that's the beauty of inflation in a hard asset model. And, we can look at this, obviously, a VLCC depreciates and it has a 25-year life, and a factory depreciates over time. But I guarantee you can't rebuild any of the petrochemical plants for what the stated value is. In fact, it's much more per unit of production than, the stated gap value or even the market caps of these things. And as a result, there's not a lot of new supply coming. And you could say, well, it's stranded capital because we're at the bottom of the refining cycle, let's say. Sure. But you could kind of like look through this and say, this asset's worth a lot more because eventually they need to add more supply and it costs too much. And I think the best example of this is something we own a lot of, which is called St. Joe, where they own about 167,000 acres of land in Florida. That land appreciates every year. And there's no depreciation. It's not like, the refinery, the ship. Like a lot of that land is just forestry. It has trees on it. It actually produces a couple percent a year yield in terms of, growing trees and harvesting trees, making paper and whatever else they do to trees. So it appreciates, plus it gives you a yield. It's a great asset. I like assets like that. And some years it appreciates faster. And during the GFC, I guess it probably depreciated for 2 years. But net, it's just like the straight line up because the population of Florida keeps growing. And it keeps attracting wealthy people, mostly because of the tax benefits. And as a result, I think Florida land does great things. And, St. Joe economically has been a huge home run. Share price wise, not so much. One day, I think investors will realize how much latent value is inside this business. And, the same can be said for, a company that owns ships or a petrochemical plant or any factory, anything. And inflationary environment, you want things that have, a certain expense to build, but you want stuff that doesn't have a lot of maintenance because the maintenance capital means that if it costs 10% more each year to build it, then it's going to cost 10% more each year to maintain it, which means that your cash flow is illusory because it just goes back into maintenance cap. I mean, you want something more like St. Joe where there is no maintenance. I guess they have some hotels and stuff, but maintenance cap is 15 million, let's say. It's kind of negligible on a couple $100 million of revenue. And most of it is just land. There's no maintenance. It's just trees. Oceanfront trees.
Excellent. So you've written that kind of your sweet spot for investing market cap wise is kind of in the $1 to $5 billion range. And that's an interesting number specifically because generally that excludes an investment from being part of, let's say the S&P 500. I think as of a couple of days ago, the lowest one was something like 4 billion and everything else in it was about 5 billion. So I'm interested in knowing, are you specifically looking for that as a catalyst? Are you looking for inclusion at a future point as a catalyst to help generate returns as part of your strategy, or is it more of a case-by-case basis?
Well, it's case by case, right? I mean, I'm not opposed to buying something that's many billions of value, hundreds of billions of value. I'm not opposed to buying something that's 5 million market cap. I mean, we've done both in my life. But I've always done is try to figure out where the opportunity is in the market, and you have these cycles, and something works for a while, but then a lot of people start making money at it, and then it stops working, and something new happens because when you shift all the money to one strategy, it means another strategy has opportunity. And so right now, what seems to be working the best is because of the nature of passive, you want things that are going to get sucked up and absorbed by passive. So if you look at a company with like a 2 billion market cap, there's usually the founder, a couple of insiders, they own 10, 20% of it. There's usually a bit of passive, 10% of it. There's a bunch of hedge funds that own most of it. And there's some free float owned by everyone else. And as it gets to about 10 billion market cap, so 5x, and remember, we're not doing anything without a 5x. When it gets to that 10 billion, the ratio of hedge funds that owns it goes down. The ratio of passive goes up. by 10 billion, it goes from 10% passive to maybe 40% passive. And so you have this forced buying. And usually we're in things that have buybacks. I just find that a forcing mechanism to force the share price higher. And remember, I don't make most of my money on earnings growth, though I do make some on a lot of just multiple expansion. It's not always like earnings multiple expansion. It's that I buy something at 20% replacement cost, I sell it at 2 times replacement cost. Then that 10x with talking about inflation, the replacement cost, it's a very virtuous cycle. And so I'm looking for stuff where passive starts buying. It ranks to 5 billion, they start buying, and because they're buying it goes to 6 billion, which means more passive buys, and eventually gets added. Maybe not the S&P 500, but it goes into the S&P 600, and then the S&P 400, and the MSCI, and then the guy at Fidelity that closet indexes, he has to buy some, and this other guy has to buy some, and it just becomes this you think of the return profile, and this is on a win, obviously, not always, but it's just like slow grind higher from 2 billion to 6 billion. And then from 6 to 15, it's 9 months. You have to own it for 2.5 years to get that 9 months at the end where, passive buys it. And I want to harvest that. Once you're in stuff that's in the S&P 500, it tends to be much more expensive. So you can look at 2 businesses, and one's the S&P 500, it trades at 25 times, and one that's not in anything, it trades at 6 times. And the one that's smaller often is growing faster because, just law of large numbers means it's harder to grow. You always have, the optionality that the big guy at 20 times buys your thing at 6 times. Why buy the thing at 20 times? You can buy the thing at 6 times. And, there's also a small chance, that you get acquired, but a much bigger chance that the multiple expands and eventually gets added to the index. And so we tend to be kicking around in that 1 to 5 billion range. Look, it used to be when I first started in this industry, there were a lot of things in the 100, 200 million range that are growing really fast. Those things tend to stay private now. Public company costs are, obsessive. And so it doesn't make any sense. Those things stay in the private market. Private equity owns them. They let those businesses mature outside the stock market. The stuff you see at 100 million market cap tends to just not be very good. It tends to be very fragile businesses. It tends to be very speculative stuff that needs equity capital, like biotech or something. So that's not really where we go hunting. Doesn't mean we won't go hunting, but even 500 million, it tends to be sort of it's really at that billion range, because to get from 500 million to 10 billion, where you get that escape velocity, or 6 billion, whatever the number is, you're looking for something to 10, 20x, that's a really heroic return. But asking something at 2 billion to get to 6 billion, that means you get a triple. I mean, that's not so hard to do. Just, you retain some earnings, you buy back some stock, the earnings grow, it's not impossible to do over 3 years. And so I'd rather hunt there. If that makes sense. And I'm sure if you ask me this question in 5 years, I'll tell you something totally different.
No, that makes complete sense. So you mentioned a little earlier just about obviously capital inflows and outflows, and how, depending on what's moving right now, like you said there, a lot of the US businesses are moving. And so people that in these really interesting and high growth emerging markets aren't even investing in their own markets. So I kind of wanted to circle that around to patience and asking you about patience, because obviously, a big part of investing success requires patience. If you're not patient, you're constantly looking for, the next big thing to happen repeatedly. Well, you're probably gonna end up losing money, because I think, like you said, your first rule obviously is to not lose money, and there's definitely a degree of patience required. So, how are you dealing specifically with the kind of inevitable times you're in the market where you have to stay patient? How are you avoiding taking unnecessary action, specifically because maybe you're bored and maybe a position that you really like hasn't moved over, maybe call it a year or so?
Oh, I just go surfing. No, I got a farm. I got my farm. No, a lot of my success in this business is being really patient, being really stubborn, and willing to suffer a lot. I find a lot of my friends, something happens, the stock's down 10%. And Kuppy, what's going on? Should I buy some? Should I sell some? I don't know. Stocks just move. Stuff happens. Bad news comes out. Does this change the thesis? No, it's bad news. A lot of times, the best thing you can do is not be in front of your screens. You make decisions, and then you let those decisions mature. And some are going to be good decisions, some are going to be bad, but you need to let it play out. I mean, offsetting this, sometimes a piece of news comes out and you go, well, thesis changed and you smash it. You just gotta get out. That's kind of rare. Usually thesis don't change on a press release. Thesis changed. It's just like over time, it kind of just doesn't work. It just kind of like grinds, and there's always like two bad pieces of news, one good piece. It just, as if you have plenty of time to just say, let's reallocate the money. But being patient is really hard. Being, unengaged in the day to day is the hardest thing to do in this business. You go on vacation, like I said, like a joke, you just need to leave the office and go surf and just get some distance between you and the screen. It's like, because if you're staring at the screen, you're probably putting orders in. If you're putting orders in, you're probably destroying capital. The event-driven side is different, but our core book, like if I'm trying to buy and sell St. Joe, like, I don't know, interest rates go up, interest rates go down. Trump tweets every 3 minutes. Like, I don't know what that means to the fact that I own a bunch of land at 20 cents to the dollar. Like, that's a good spot to be. I mean, the land's going up. I'm earning high returns on my capital. Like, so I think it's really hard to be patient. And I think, especially in the world that we have, where, remember we talked about at the very beginning, I run a hedge fund. A lot of people run hedge funds. Their hedge funds mostly are focused on having no down months, which means that they frantically have to avoid problems. This is going down, I got to sell it. This is going down. Like when it's going down, like I don't want to sell it for less than it was yesterday. I probably want to buy some more incrementally. But their mentality is you sell on the way down, you buy on the way up because you don't have down months. And my mentality is the average stock moves around a lot. It's totally random.
Yep, I completely agree with you on that end. So another point that I want to bring up here is how you run the fund unhedged for pretty much all time. And so your thought process there really resonates with me because, kind of getting to your point here about what other funds do, a lot of the times they're hedged, and they're using complex hedges like, if I buy stock XYZ and it goes down, then ABC will offset it by going up. But in practice, I think the gains and losses from these hedges tend to just cancel each other out over time, leaving you with, kind of a mediocre performance. And worse, like let's say you have a really, really good idea that has a long-term tailwind and can maybe compound over multiple years. If you're then hedging it, you're basically just degrading that upside potential with another idea that's likely to underperform. So, for some of the value investors that are listening, many of whom are definitely investors who are trying to build portfolios specifically catered to their best ideas, how do you think about the trade-off between, accepting volatility versus trying to smooth the ride? And, what advice would you give specifically to investors who feel tempted to maybe hedge, but may not realize that they're just watering down their best idea?
I mean, there are times where hedging makes sense. Stocks about every 3 to 5 years go down a lot, and it lasts for about 6 months, and then it's over. And if you're really good at timing this stuff, you should be hedging. Most people are not good at timing this stuff, including me. I'm terrible at timing this stuff. I'm always too early, and then I usually give up trying to hedge right before it actually falls apart. So that's why I don't hedge anymore. I just don't believe in it. Look, stocks go up over time. They go up a lot over time. And if you own good companies, they're almost immune to the volatility. And oftentimes, whatever hedge you're going to use is going to be tied to MAG 20, which is probably not really correlated to what you own anyway, or it's not correlated to what we own. So I don't really understand it. I mean, if you're bearish MAG 20, go short MAG 20. But don't think of it as a hedge. Think of it as a directional thing. But I found a lot of my friends in this hedge fund industry, they do really well in their long book. Like they're actually way better stock pickers than the market. And then they suffer on their short book, and net, they kind of track the market, underperform slightly, which is unfortunate because let's say their long buck is, doing 1,000 bips of actual alpha, then they lose 1,500 bips in the short buck. And I don't understand why they do it. Plus, when they're trying to hedge, there's always slippage costs, there's commissions, there's this frictional cost, taxes, which are, big for clients. I don't think it makes any sense, really. I mean, the way I look at it is that I know there's going to be volatility. I know that about every 18 to 24 months, we're going to have a down 30, 35 even. I tell my clients this, when the market really gets hit hard, we might have a down 50. I mean, we had a down 50 during COVID. It's going to happen again. And the whole point is you set up your portfolios that when there is a down 50, you don't get kicked out of the game. You run with a leverage profile that lets you hold on to what you want to hold on to. And hopefully at the bottom of the cycle, you're always going to be early. So you're going to average in too soon. You get to buy some more. And that's why we target that 115, 125. It gives us room to add on a proper pullback. It gives us room to, cycle some stuff around. I know that I'm going to have it down 30, I don't know. But I like to think that venture is going to do very well in a moment like that and be additive, which lets me, have that cash flow to average down too. But I just accept it. And I think, every client in my fund, I have told now that we will have a down 30 to 35 every 18 to 24 months. We expect it. And if you're not prepared for that, don't invest. And if we have one of those, you should give me some more money. It's a great time to invest. And basically, it's inevitable, right? And so you have the hedge fund that decides they're going to raise $10 billion. That's their business plan. I don't fault them because they're going to make more money than me probably. And they want to have no down months. They have to be hedged. Fine. My business plan is to grow my PA. And I accept that we're going to have a lot of volatility. Once you accept this, it's very cathartic. It's very calming. It's just like, we're down 10%. I guess we'll be down to 10 to 20% more. And then it probably just doesn't go down much more. Like if it's happened to you a bunch of times in your career, you get sort of used to it. And I just think it's the hedge fund world, because of the need to always be raising capital, has just never accepted this fact. And because they can't accept it, they panic and they scramble and they just make the problem worse usually. To any hedge funds listening to this, or to anyone else who's listening, just accept that it's going to be volatile and you can't really do much about it.
Yep, completely agree. So you wrote, inflection investing works in most market environments, even the ones where most market participants are chasing, let's say, an AI bubble, assuming there actually is an inflection in underlying financial performance. So my question here for you is, what are the signs of an inflection point that maybe value investors should wait for before deploying capital into an optically cheap but maybe stagnant business? I know you said that you're always too early here, but maybe you could share some of your lessons on how you can maybe optimize that into the future.
Well, it's obvious when it's reflecting, right? What Wall Street cares about, and there's only one thing they care about. They want to see revenue growing and they want to see earnings growing. That's it. And Wall Street tends to have a preference for revenue growth as opposed to earnings growth because of the Amazons of the world. They've been deluded into thinking that if you keep growing the revenue for long enough, eventually earnings catch up. And sometimes they do, sometimes they don't. But as a result, Wall Street really cares about revenue growth, which is why we've had all these weird Ponzi bubbles where companies will buy $1 of revenue because they do it at a negative 20 gross margin. And, if you let me buy something worth $1, at a discount, I'll buy a lot of it. And so they get all this revenue growth, and then they can raise more money, and it's a nice little Ponzi bubble until it kind of pulls apart. We've seen a lot of these sort of Ponzi cycles. But Wall Street wants to see that growth, and they want to see it accelerating. Remember, rate of change. So you look at a bunch of industries, and you say, what industry will next year have both revenue growth and earnings growth, and the rate of change is going to accelerate? Because a lot of businesses they're pretty steady Eddie. They grow 10% a year every year. So you need the growth rate to accelerate to 20%. It needs to be faster than what everyone's modeling. A lot of things I look at, they kind of kick around at break even, and anything positive is really, really good. And so you get more acceleration. But that's all you're looking for. It should be pretty obvious. And going back to the AI thing, look, I'm kind of a little bitter that I didn't catch it. But look, these things accelerated. The revenues exploded. The earnings actually, some of the businesses, there were earnings, but the revenues absolutely exploded. I get why people got excited about it. I totally get it, right? And I get why, some of the things I owned that went down last year, it didn't accelerate. It was year 3 of a 10-year cycle, and we had deceleration this year. And so, okay, I get it. I need to suffer because my businesses are suffering, and those businesses need to prosper because it's actually inflecting. I get it conceptually. I'm one of those guys that likes to look at, earnings and valuation, but I understand that certain people don't care. So good, let the tech guys have fun, 1 year, it's not like they haven't won 20 years in a row. Let them have one more year.
So I really enjoyed one interaction that you shared with a friend who regarding NVIDIA. So you said your friend was upset because he didn't own NVIDIA, and since he was, trying to track an index, which we've been talking to about a lot this episode, his performance was lagging behind that of colleagues who obviously did own a business like NVIDIA. So I think it's a really interesting example because it feels kind of like an echo chamber of the market at large. Investors are pretty social people, and they have an excellent idea of what their colleagues and friends buy because either they talk to them or there's a ticker flashing at them throughout the day telling them what's being bought and sold. But you've kind of managed your investing game specifically to bypass this pain point that most investors have navigated. Hopefully, obviously, your results kind of speak for yourself here. But I'm just interested, how exactly did you land on this approach? And also, more importantly, why do you think it's so hard for other investors to kind of navigate that issue?
Well, I think the reason it's hard is that for 18 months, all people talked about is NVIDIA. I mean, look, NVIDIA peaked out last summer. It's gone kind of nowhere, incrementally down. And everyone still talks about it all day because that's all the media wants to talk about. I mean, it trades tens of billions of stock a day, hundreds of billions of stock a day. I think the option trading in NVIDIA is more than the stock market itself. So it's this giant casino, and everyone wants to be in the casino. It's fun to go to the casino. I totally understand why there's a lot of focus on that. And look, we've traded NVIDIA mostly from the short side. We've done okay. But I understand why there's a certain draw. And when you have a very large stock that goes up every day and it's a large piece of people's benchmarks, there's a certain incentive to overweight it because it's going up, which means that you have to overweight it more because it goes up. And it's very reflexive. And I can understand why a guy that runs a multi-billion-dollar mutual fund where outperformance is 50 or 100 bips feels a lot of pressure when he's underweight NVIDIA and it just won't pull back and let him in. I had a friend who he was crying to me about it, and the way he was crying, I thought he was short, and no, he was just 100 bips underweight. Like, I don't know, I just don't think that way, because well, I guess NVIDIA was a multi-bagger, but I'm mostly looking for stuff that'll multi-bag, and so a lot of large cap stocks in these benchmarks, they don't multi-bag. I mean, every year one or two of them will, but like a lot of them, they kind of do 20-30% a year. That's a really good year. Like, I just don't care. It's not my world, so I just don't really think about it much. I mean, like, you see it, like everyone talks to you about it, but it's just not my world. My world is a bunch of things that no one's talking about, no one's thinking about, and when they start talking about it, I usually exit.
So Harris, I want to just say thank you so much for coming to the show today and sharing your insights with me and my audience. So I'd love to give you a handoff and maybe let you tell the audience where they can learn more about you.
Sure. I mean, I always say go follow me at Twitter. I guess they call themselves X this week. My handle is @Kuppy. I'm sure about half of you will block me because you'll be offended by something I say, but the other half of you will enjoy it. Otherwise, go to my website at Pracap, pracap.com. We have information on my fund there, but I also write a blog. I used to write a lot more. I tend to write when there's something that's happening that's interesting, and quite honestly, it's been a really confusing world. So I've written less lately, but that goes in cycles. And then finally, we have a publication called KEDM, KEDM, and it tracks these 25 event-driven strategies. And I really recommend you take a free trial. And I think if you're an active trader, it'll change how you trade because these are real catalyst events. And I just think it's a great product. We literally built it because we wanted the data. So anyway, that's my sales pitch.
Perfect.
If you want to become rich, generally you need to understand micro quite well. And if you want to stay rich, you need to understand macro well. There's only so many ways you can lose your wealth if you have a lot of money. Concentration is one, leverage is another, and then you also have hyperinflation. And most people don't think about hyperinflation because they never experienced it, so it makes complete sense why you wouldn't consider it. But whenever you reach your number, I don't know, let's say $10 million, $100 million, but you have to focus a lot on your downside, and hard money falls into that category for some investors, certainly not for all value investors. And owning hard money might take a little longer to double your portfolio value, but it also gives you some downside protection.